Okay, guys, not sure what happened when I went back to review the video. It kind of cut off when I started talking about long-term debt, so we'll go back over and revisit this. Just like short-term debt, what do we know about long-term debt? Almost just the exact opposite. You know, it's going to have a maturity of greater than 1 year, so we're looking more in the long term because we're looking to finance things that are on a more permanent basis. So land, brick and mortar, infrastructure to conduct the activities of our business, maybe some equipment for our business. So we're looking more in the long term with long-term debt, so more permanent here. So just to go over some key terms that we need to be familiar with, term loans, just those loans from banks or financial institutions. Many of you should be familiar with that, especially if you've taken out some type of loan for graduate school or for a car or for a house. These are more like term loans, where bonds are usually sold out to the public at large or to the general public, and people can go out and buy those. So bonds are more long-term contracts that are held to specific dates where payments of interest and principal are made on that bond to the holder of the bond. So if you go out and buy a bond, there's certain dates throughout the year that you're going to get interest back from that bond. These are also registered with the SEC, and so if you'll recall, this is a Securities and Exchange Commission, so every bond that's out there on the market that's been purchased is registered with the SEC, and these are generally used to raise or finance some kind of business activity or some kind of activity out in the marketplace. So just looking kind of like a quick short little quiz for you. Who would issue the following bonds? So we have treasury bonds that are of course going to be issued by the federal government. We have corporate bonds that are going to be issued by for-profit corporations. And then we have municipal bonds that are going to be issued by their counterpart, the non-for-profit healthcare providers. Which in turn, these are actually issued by governmental financing authorities on behalf of those healthcare providers. So there's three types of bonds: treasury, corporate, and municipal, each issued by a separate entity, treasury being federal government, municipal being non-for-profit, and corporate being those for-profit corporations. So just to understand debt contracts, you know, when we go over them through the book, they have a couple different names. Bond indentures, loan agreements, or promissory notes. So many of you may be familiar with promissory notes because you have to sign one for any kind of educational loan that you take out. It's called a promissory note. So these are debt contracts. You've entered in some type of contract agreement regarding this debt, saying that you'll make these certain payments on these predefined dates and times. They usually contain, you know, these strict covenants saying that you'll pay the amount in full by a certain date, and they have a maturity date when that debt contract must be paid out, along with the interest rate and the type of debt that you're about to enter into contract with. So if you know anything about the stock market or about debt ratings for different companies, there's going to be a couple different rating agencies that assign different types of debt ratings, and each company and corporation has a certain type of debt rating according to one of these three entities. So you have Moody's, the S&P, and the Fitch. A lot of you may be familiar with the S&P. That's one you hear a lot. So if we look at investment grade, these are higher grade debt ratings. That means the company's in very good financial position. They're not as risky, especially if you move up to a AAA. You're not as risky according to Moody's, so you're a very good investment. Any potential lenders and loans would take a very low risk in entering into a debt contract with you. Now, as we move on down, investment grades are considered anything AAA through BBB. These are investment grade bonds. Now, when you start moving down into the speculative bonds, these are BAs down to Cs, and these are also, you may have heard them called junk bonds. So these are more risky. You're going to see higher interest rates in these types of bonds. The S&P have also AAA down to BBB as investment grade, and then BB down to D for speculative, and then Fitch along the same lines, AAA for investment grade all the way down through to BBB, and then starting BB through D are more what we consider junk bonds. So there's a couple different characteristics that we need to look at in determining how bonds are priced, or what would determine bond pricing. The face of the bond itself, which is also called the par value. Our interest rate, if you think back, is also called our coupon rate. The rate of return and the time to maturity. So we looked at a lot of this through time value analysis when we were talking about the NPV or the net present value. Some of these terms may look familiar from that particular module. But then how do we take how we determine bond pricing and determine the criteria we would use to rate bonds? So going back to if they're AAA, BBB, or they all the way down into the junk bond status. So what we would look at is the financial condition as well as the competitive situation. We would look at their management structure and overall the quality of that, how well they're managed. And we look at a lot of objective and some subjective factors that go into rating bonds. So what does this mean to you as a consumer overall? The rating overall is going to give you the default risk. And like I said, it's going to have a play into the interest rate from the lender. So if you have a very high rating, you're going to have a very low interest rate, and the reverse of that, if you have a very low rating, if you're down in junk bond status, you're going to have a very high interest rate or a higher comparative interest rate. So the importance to investors, we want to be safe. We're naturally risk averse, so we want to take the safe bet, and typically as an investor, you're only going to go out and buy BBB or higher because those are your investment grade bonds. So when I think about how a change in a rating, maybe going from a BBB, a BBB down to a C bond, is going to have an effect on a corporation or an organization's ability to borrow in the long term for more of their capital needs. Because remember, we said, businesses need capital to acquire the assets they needed to provide services. So if we have a change in our rating scheme, how is that going to affect our overall ability to purchase assets to be able to continue to provide services? So if we drop a grade, maybe down into a junk bond, we're going to have a higher interest rate, which is going to put us in a position where we're not as financially able to afford capital as we are if we have a higher rating, because our interest rate will be higher and we'll have, we'll be able to afford less overall. So think back when we were talking about expected rates of return and expected rates of return. When we talk about yield to maturity on a bond, this is the expected rate of return when we assume that the bond we purchase is going to be held to maturity and that we're not going to default on it overall. So this is called our yield to maturity on the bond. So the discount rate is going to force the present value of the bond to equal the bond's price overall. And just to finish up our talk about bonds and risk rates, long-term bonds are going to have a high risk, high price risk, but low investment rate risk, where short-term bonds are going to have that low risk with the high reinvestment rate risk. But nothing overall is riskless. Nothing is an absolute sure bet per se. There's going to be a little bit of inherent risk in everything and every activity we undertake. But we can kind of minimize and mitigate our risk by matching the maturity of the bond to the holding period. So the second major source of capital for our healthcare businesses is called equity financing. And so for investor-owned businesses, equity financing is going to be provided by the owners, where in non-for-profit organization, equity financing is provided by our communities at large through things like our earning retentions or maybe grants or through general contributions or donations to the organization overall. So we're going to look a little bit into equity financing and securities markets. So we know from the very beginning of the semester, there are a couple ways that for-profit businesses are organized, and those are in the form of proprietorships, partnerships, corporations, and hybrid forms. So when we think about the for-profit business structure, so this is just a little bit of shift of what we were talking about, in the previous couple modules and lectures where we focused in a lot on non-for-profit. Here we're going to talk about for-profit for the next little while, and we're going to focus in on stockholders as the owners or shareholders as the owners, simply because we find most of the healthcare managers in this setting work for more corporations. So we're going to look at stockholders and shareholders as the owners in this scenario. So there's a couple rights that stockholders have and have a claim on. The first of those is claim on the net incomes of the business, so the money that's left over after we pay all of our expenses out. And it essentially belongs to the shareholders, so they get that paid out in some form of dividend. If you invest in the stock market, it's a similar setup to what we see there, where you're getting paid a certain amount off the performance of that investment that you've made. They also have something called the preemptive right and have the ability to kind of exercise control over the firm because they essentially own a share of the firm, and that's why you buy shares you can buy shares into for-profit organizations. But we're going to look a little bit more at the preemptive right and exactly what it is and what it details. And of course, I love little videos, so I found this video that does a good job of explaining the preemptive right, and then we'll follow up after that with a couple key points.
Now, since a corporation is an artificial legal unit established by the state, a firm issues a certificate of incorporation, which states its sole purpose, the number of shares authorized, and the location of the home office. In addition to the certificate of incorporation, the firm also receives a charter. Now, a charter establishes the relationship between the state and the organization. Now, in the first meeting here, the investors, the owners, set bylaws and established for the organization and voting rights, particularly voting rights for the board of directors. Now, there's three important features to consider. The first one is called or referred to as preemptive right, which allows a stockholder to maintain current proportion of shares owned. So, for instance, let's look at just give a quick example. Let's say that the organization has been authorized for 100,000 shares, and let's say Mrs. A owns 10,000, or in this case 10% of the number of total authorized shares. If the firm decides to issue 50,000 more shares, since she owns 10%, she is authorized to purchase up to 5,000, which will maintain her current the amount proportion of owned shares. That's referred to as preemptive right. Another feature is the calculating the number of votes. There are two ways. There is statutory voting and cumulative voting. Now, statutory voting basically states that you get one vote for each item on the ballot, for instance, let's use the example of electing board of directors. And let's say there's 3 seats, seat 1, seat 2, seat 3. In this case, you could throw 100 votes this way, 100 votes here, and 100 votes here. However, if it's cumulative, which Actually, this is better for a larger voter. For the smaller voters, cumulative is better. Smaller voters, larger voters, small voters. Let's look at it for the smaller voters. Let's say we have those 3 seats, seat 1, seat 2, and seat 3 again. We could allocate in any way we want. So in one instance, we could throw, since there's 3 seats and we have 100 votes per seat, which 100 votes times 3 gives us 300 votes, we could vote all for 1 here and 0 here, or we can allocate it in any manner of fashion we want. We could put 150 here, maybe 50 here, and then 100 here for this seat. Like I said, we have a cumulative voting, since there are 3 seats, 100 shares, which is multiplied together. We have a total of 300 votes. We can allocate it any way we want. So I hope this helps understanding 3 important principles: the preemptive right, statutory voting, and cumulative voting.
Okay, guys, so just a good little intro into preemptive right to kind of set us up for some things we're going to be talking about on the next couple slides regarding preemptive. So overall, preemptive right, just giving the shareholders that opportunity to purchase new shares before they go out to the general public. But how does it go about protecting the power of control? So management of a corporation under criticism from stockholders could really work to secure its position by issuing a large number of additional shares and purchasing those shares themselves or selling them to a friendly party. So management would gain control of the corporation. Now, because we have the preemptive right, this works to help secure the stockholders' power of control, per se, over the organization. I already gave you the answer, but let's say that Health One HMO has 1,000 shares of stock. And we're going to sell those for $100 each. So the total market value, of course, is $100,000. So let's say that management sells an additional $1,000 of shares to their friends at $50 a share. What's the new market value of the Health One stock? And it's going to be $150,000. So what we're going to show you here is kind of what we talked about. There's the answer, $150,000. So what we're going to show you here is what we kind of referenced here on the last slide, how the preemptive right really works to protect stockholders against dilution, so that they're not losing money per se on each one of their stock purchases. So then, taking the information that we just went over, how many shares are outstanding now for the HMO? So we had, let's go back a slide. We had 1,000. Management comes in and sells another 1,000. So now we have 2,000 shares of stock outstanding with a total market value of $150,000. So what's the new price of each share now? So we know that the stockholders originally purchased these shares for $100, but now with those extra 1,000 shares thrown out into the marketplace, the answer for the share price of each share of stock is now $75. So the investors who originally bought at $100 have now lost $25 per share because the market is starting to become diluted. Now the preemptive right can step in and kind of keep this from happening, so to protect the shareholders overall. So we have 2 different types of common stock. We have privately held, which is not traded in an organized market, and then we have publicly held, which is traded on down on the NASDAQ or listed on other stock exchanges like the New York Stock Exchange or the American Stock Exchange. IPOs are initial public offerings. These are going to occur when we have a privately held company that's going to sell stock on the market for the first time, or it's going to go public. So a couple years ago, Facebook went public and started to sell shares. They had something called the IPO, the initial public offering. For the first time, they sold shares out on the public market, or that they went public. So the primary market is when we have new shares sold by publicly owned companies, and the shares between individuals. So we have primary market where new shares are sold, and then we have secondary market where sales occur between individuals themselves. So let's change over and talk about non-for-profit businesses just for a second. So non-for-profit businesses have two types of equity financing. They have retained earnings, and they have new stock sales. So remember, they have those municipal bonds that they can go out and sell. NFPs retain their earnings, but they can't sell common stock to raise equity capital because they're non-for-profit. So they can retain their earnings, just can't go out and sell that common stock out on the marketplace. So when we look at the origination of our equity from a non-for-profit standpoint, we have really two different ways. So startup equity can come from governmental entities through like grants or small business development loans, things like that, or religious organizations. And then after our startup, we have ongoing equity that can come from any profits we make or revenue over expenses if you're talking about non-for-profit. Contributions or donations and then grants are all considered ongoing equity components. So the last section we're going to talk about is the cost structure and cost of capital. So what we're going to be talking about here, is there really that optimal mix of debt and equity for any given business across the spectrum, or what's that cost going to be that's associated with a business's capital and their capital purchases? So capital structure decisions, we already learned, are called, capital is going to fund the assets to run the business. So capital structure is really that financing mix on the right side of the balance sheet, which is, think back to when we were talking about balance sheets, this is the liabilities and equities side of the balance sheet. So the other side, we had the assets. Now we have the liabilities and equities on the right side of the balance sheet. So what two questions are going to be asked when we start talking about making capital structure decisions? And we're going to ask, is there, like I said, that optimal mix of debt and equity? And if there is, what is it for any kind of given business that we're going to be discussing? So when we talk about and think about debt and capital financing, we know that overall debt financing is going to lower our net income, but overall it's going to increase that return we pay out to our owners. So debt is not inherently a bad thing, although it is painted in a bad light. Sometimes we do need to go in debt to help finance our activities for the business for overall in the long term. So debt financing is going to allow more of our organization's income to flow through to our investors. And this is called, it levers up or increases the return. We're going to call it financial leverage. But we know because debt can be uncertain as well as operating income, when we have that level of uncertainty in our income, and we consider that we use debt financing to increase our owner's risk, and then thinking about the amount of financial leverage we have, the greater amount of financial leverage, the greater amount of debt financing, the greater the risk we have. So we really need to start weighing the risk versus the return, and if we're going to get the trade-off or the ROI that we're after through debt financing. So we have a couple different factors that influence risk. And these all deal with certain types of uncertainty that we can anticipate out in the marketplace. So we are going to be uncertain about the volume and the price as well as the cost. We know that those fluctuate with different events happening out in the economy, and our economic indicators create a lot of uncertainty, especially around pricing and costs, but also liability uncertainties and our degree of operating leverage. Which if you'll think back to, how the text defines operating leverage, we're looking at the amount of the fixed cost in the business's cost structure overall. So when we start to define business risk, we're looking at the inherent risk when the business uses no debt financing. So they haven't went into debt to finance any activities, but what kind of risk does that present overall in terms of or in relation to the business? So the difference overall between financial risk and business risk is financial is that additional risk that we put on the owner when we use debt financing. So we have business risk there in terms of using no debt financing, but what is that additional risk we're putting on the owners when we incorporate debt financing in? So the question then becomes, if we have a business that has a lot of debt financing, what does that really mean for financial risk? So the greater the debt financing in our capital structure overall, we're going to assume that there's going to be greater financial risk. And how we know that is because total risk is going to be the sum of business risk plus our financial risk overall. So a couple factors that play into our abilities to make capital decision makings, make those more capital decisions. Of course, we're looking at risk. We're looking at ratings. So go back to our bond ratings, AAA through BBB are those investment grades, and anything below BBB are more of those junk bonds. How well our ability is to borrow and how much we can borrow, and how we compare that out to industry averages. So think back to when we were calculating our ratios. I had you compare the ratio calculation for our debt. What is our debt ratio? How does that compare out to the industry average? And so how do we look overall compared across the industry? And then it also plays into our ability to buy, finance, and purchase our assets to continue the operations of the business. So we've talked a lot about investor-owned businesses is what the conversation is centered most around, but the same concepts apply over to the non-for-profit side. We're going to have a benefit to debt financing, but we're also going to have some costs. But as a non-for-profit organization or a business, we don't have the same financial flexibility as we do or what we see with investor-owned businesses. I'd really like to hear your thoughts on this. If you can, post your answers to the discussion board to let me know why you think that is. Why do you think that non-for-profit firms don't really have that same financial flexibility that we see in investor-owned? And I'll kind of keep a monitor on the discussion board, and we'll revisit this question next time that we're in class. As far as chapters 11 through 13, guys, this was really simple, straightforward. Like I said, I took a little piece and part out of each one of those chapters that I felt was most pertinent because there was a lot of information that I felt was really beyond the bounds of this class. But if you do have any questions, please feel free to contact me at any time. And guys, we'll see you next time.